Hello, I'm MaryAnn. U.S. crude oil inventories dropped 10.6 million barrels last week. This is the biggest decline we've seen in roughly a year. But is that good or bad for the price of oil? I'm joined today by Bart Melek, who is head of commodity at TD Securities. Good to see you.
Great to be here.
So what does it mean, Bart?
Well, lately hasn't meant very much. Normally a drop of this magnitude, one that is compounded with previous drops, would have meant significantly stronger prices. This hasn't really been the case of late. The key reason, of course, is less geopolitical risk in the Middle East, ample supplies in the United States, overcapacity in Canada, and the very strong probability that we'll see a lot more Iranian oil now that there is a nuclear deal between Iran and the United States next year. This implies that we probably aren't going to see an awful lot of upside in oil anytime soon.
So we're down to, in WTI oil around the $97 a barrel mark. Are you expecting that to stay about the same or go anywhere?
Well, in fact, as year unfolds, we think it's probably going to trend towards 95 rather than the 100 mark. And again, as I said, the risk premium is less now than it was, and that risk premium, because of the Middle East mainly, will likely be reduced even more. And there isn't a strong likelihood that supplies are going to get materially tighter after the cold season is over.
So is that because there's more oil being produced out of the U.S., or is it all mainly to do with the Middle East?
Well, it's a combination of all those things. There will be likely more oil from the Middle East. There'll be more oil in North America. And while demand is recovering, it's not anything spectacular.
Okay. Let's look at the difference between maybe we've seen Brent crude at 109 and WTI at 97, and that seems to be narrowing. Is that the case, or what do you see?
Yes, we see that Brent WTI spread narrowing. We see that continuing as 2014 starts and as we move further in. And the big reason there will be less geopolitical risk in the Middle East and more availability from countries like Iran in the next 4, 5 to 6 months. That will likely close the gap a little bit further between Brent and WTI. You'll get a situation where you no longer have this relative oversupply in North America and a big scarcity in Europe and markets that are destined for oils that are destined for the Asian markets. And with more Middle East availability, that gap should close.
So with the price of oil not really changing, would you invest in oil right now?
Well, that's always a tough question. I would probably be more disposed of going short on crude. Several things are going to contribute to that. Of course, we've already talked about the supply-demand balance, but also with the Federal Reserve starting to taper probably early next year, we are very likely to see a fairly strong U.S. dollar, and the relationship between the dollar and commodities generally isn't necessarily good for prices. A higher dollar usually implies somewhat downside pressure on prices.
So probably more volatility to come.
We're going to certainly see volatility.
All right. Thank you very much, Bart.
It was my pleasure.
I've been joined by Bart Melek, who's head of commodity strategy at TD Securities. Thanks for watching. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.